Good afternoon. Welcome to our class. So the morning we did introduce on how to or accounting for material. Okay, and the key takeaway there was you have to be quite careful when it comes to the distinction of the material. Okay, whether the material or whether the material cost is a direct material cost or it is an indirect material cost. Okay, so care has to be taken from that angle. Okay. Because when it comes to accounting, then account for that material cost is different, okay, as we saw, okay, where in the case of the direct material cost, okay, we account for them as part of the product cost, okay. In this case, we put them in the work in progress account, okay. If they are indirect material costs, okay, then of course we do put them under the production overhead cost, okay. So you have to be quite careful when it comes to the cost classification, how we classify the cost, okay, whether it is an indirect or is a direct material cost, okay. So let's discuss on valuation of the inventory, okay, inventory valuation. So you can use three methods to value the inventory, to determine the value of the inventory at a point in time, okay. So the first is called the first in, first out inventory valuation. We have called last in, first out inventory valuation method, okay, and you have the use of the weighted average pricing method, one of them being the cumulative and the other called the periodic weighted average method. Okay, so as per saying, we can have four methods of getting the inventory cost, okay, or getting the inventory value, okay. So those are four other candidates, okay. So I want us to go through each one of them, okay, on how you value. We determine the value of the inventory, for example, the closing inventory, for example, the opening inventory, okay, at a certain point in time, okay. How would we get the value? How would we get, in short, include the cost, okay, of the inventory at that point in time, okay. So you can use that for those formulas, okay? Fifo, Glypho, and you can also use the cumulative average and the periodic average, okay? The two formulas we can use when it comes to getting the cost of the inventory, okay? So let's begin the first one, the use of the first in, first out method, okay? The use of first in, first out method, okay? In the first in, first out method, okay, the FIFO, okay, what happens is that we're going to be valuing the inventory, okay, based on what came first, okay, what inventory were first to be received, okay, what inventory or inventories were first to be received, okay, because the inventory that were first to be received, okay, are the one that the company will be selling from, okay. Well, that means that if, for example, we had inventory which we bought maybe yesterday, okay, and today we want to make a sale, okay, the sale to made today, we first sell from what was there yesterday, okay, before we sell the commodity you have just bought in, okay. So it's first sell, okay, the item that were first to be received, okay, I call the first in, first out, okay. You first sell the items, okay, that were first to be received, okay. The items, which means therefore the closing items, okay, at the end of the day, okay, what you'll be having, if there will be inventory that are still outstanding, okay, that are yet you didn't make sale from, okay, then they will be made more of the items that were received, for example, today. The sale you have made today, the sale you have just made today, okay, they will be made of items, okay, that were there yesterday, okay. So you sell first for the items that were first to be received, okay, first in, first out. Okay, as I mentioned, the closing inventory, okay, the closing inventory is made more of items that are most recently acquired, okay. So the closing inventory is made more or less of the items, okay, that have been most recently acquired items. Okay. Now, what that means therefore is that if we do have a case, okay, where the price of commodities is increasing, okay, if we have a case where the price of commodities is increasing, okay, then what happens is that you're going to be having items, okay, more of the closing inventory will be having a higher value than the items that have been sold from. If we have a case, okay, let me just repeat, okay, that point. Now, in case we do have the scenario where the price of commodities in the market will be increasing, okay, that for example, the price yesterday is $10, the price today is $15, okay, that means therefore the closing inventory, the one that are yet to be sold by the end of the day, they're made more of the items that we have bought today. So if we have their value per item is $15. Okay, which means therefore the closing and the sales, okay, for the day, for example, okay, they're made from the items from yesterday. Okay, that means therefore they have a value of $10. Okay, therefore we have a case where there will be the value of the inventory being much more higher than what has been what has been the cost of the items the company is selling. And since the sale occurred today, okay, since the sale has occurred today, okay, and the items were bought yesterday at 10, and the current value is 15, because the company therefore will be selling at the price higher than the cost today. You get it? Let me repeat. I think let me explain through. Let me just state the point I want to draw across. Okay. Okay, so let me just say that point. That's the sales for today. Okay, the sale for today. Okay, that is let's say we call it 4, and yesterday was 3rd. Okay, today is 4th. Okay, the items in yesterday we bought items. So here I have purchase. We bought items. Let's say we bought, for example, $10 of that item at $10, and we bought items. Let's say 20 items or 20 units. Okay, today we make a sale. Okay, so here is a sale. We make a sale of how many items? Let's say 13 items. So 13 items, not dollars. 13 items or 13 units. Okay, and the price today, at the same time today, we make purchases. We buy other items. Let's say we buy, for example, 10 units. We buy 10 units. Let's say our the price is increasing from 10. That's $15. Okay. So since the value of the item has increased, okay, the cost has increased from 10 to 15, okay, and the same will be applying even with the price, okay. As the company is selling items today, there's no way they're going to sell at $12, okay. Most are going to be selling at a price higher than 15, okay. Would imply therefore, for example, if the selling price is, let's say, $20, okay, which is price higher than $15, the cost as per the current term, therefore the selling price, the revenue to be earned will be 13 items times 20 to give us 260. Okay. However, the items we sold today, these 13 items, they were bought yesterday, okay, at 10, which means therefore the cost of those items, okay, will be 13 times 10 times 10. Okay, 13 items times 10 to give therefore a cost equal to $130. The profit therefore to be reported today, okay, the profit that will be reported today will be equal to, therefore, will be equal to 130. However, if you assume that we have a case of the price was static, okay, the price was static, okay, there was no increase in price, okay, between that day and the 4th day, okay, then the selling price, okay, and see that here, let me just do a simple adjustment, the price here remain at $10, the same price that was yesterday, okay, and the company want to make $5 per item. Therefore, the selling price will not be 20, but will be 15 this time around. Because the price today is $10. The company want to make a profit of $5. Therefore, they'll be selling at $15. Therefore, the revenue to be earned will be equal to $15 times the item sold, $13. Okay, to give us how much? $165. You therefore have a selling value of 165. Okay, that's kind of the revenue. Okay, now don't forget that in items, okay, is 165. 165?
It is 195.
195. 15 times 13, 195. Okay, 195. Okay, 195. Yes, 195. Okay. The items, don't forget, we bought them yesterday at a price of $10. Okay. The 13 items, therefore the cost means still remain at 130. Therefore, minus 130. And therefore the profit to be reported for this year will be 65. As you can see, okay, the price here, the profit to be reported, okay, therefore, is higher, 130, compared if the price was to remain constant. Compared if the price was to remain constant, okay? What that implies, therefore, is that in case the company is using the first in, first out, like I've done here, these 13 items, you sell them first from what was there in the previous day. These 13 were picked from the 20, okay, don't forget. These 13 items, they were picked from 20. You cannot pick these 13 from the 10 items bought in today. You have to sell first what was there yesterday. Therefore, their cost was the $10 here, okay, like you've just done, okay? If that's the case, therefore, they begin to be, we have a case where the profit to be reported, okay, may be inflated, like you've seen here, okay, 65, but now it's at 130. Okay, the profit to be reported, therefore, will be inflated, okay, due to the increase in the price of commodities between the third day here, for example, and the fourth day. That's either the first in, first out, okay. Let me give another example. If, for instance, we have here the first day, second day, third day, fourth day. On the first day, 10 items were bought and called units, and a cost of, let's say, $8. This is purchase. This is the company bought these items. On the second day, the company bought, let's say, 5 items at a price of, let's say, $10. This is another purchase. On that day, the company bought another items, 10 items or 10 units at a price of, let's say, $12. Okay, there's still another purchase made. On the fourth day, the company make a sale, and the sale that they make is, let's say, 20 items. So they make a sale of 20 items, okay? So the question is, what's the cost of these 20 items that the company has sold on the fourth day? If you were to use the first in, first out method, okay? Let's do the analysis. I mean, above this. I hope you got the scenario. The scenario is that we bought some items, okay? And these items were bought on first day, second day, third day. In the fourth day, the company makes the sale, okay? In the fourth day, that's when the sales are occurring, okay? So the question is, for the items of sale that was made in the month of, or it was made on the fourth day, okay? These 20 items, this is a sale. Let me actually make it clear that this is a sale. Okay, this is a sale. The others, okay, there's a purchase, there's a purchase, there's a purchase, okay? However, the fourth day is a sale of 20 items. The question is, what's the cost of these 20 items the company is selling on the fourth day? Is the scenario clear? So you need to have the scenario cost clear. Alexander, is the scenario clear?
Yes.
Okay, great. Okay, so the question is, what's the cost of these 20 items the company is selling on the fourth day? Now, don't forget, it's first in, first out. So before you pick the items bought on that day, you have to first sell the items bought on the first day. So let's pick the items from the first day. Okay, so the first day, the company has 10 items. Okay, 10 items at a cost of $8. Therefore, the cost of those 10 items is 10 times 8. Okay, to give you therefore 80. On the second day, the company had 5 items, so 5 times the cost of those items, which was $10, give you a cost of 50. On the third day, the company, okay, had 10 items, but the sale made on the fourth day is amounting to 20. Okay, so the items here of sale are 20. We took 10 from first day, 5 from the second day. Therefore, in that day, how many items do we pick from the purchase made on that day?
5.
Of course, 5. Therefore, on that day, we pick therefore 5 items. Their cost is 12. Don't forget. Okay, therefore, it'll be 5 times 12 to give therefore 60. Therefore, the total cost of the items that was sold on the fourth day, on the 20 items here, okay, is the sum of 80 plus 50 plus 60 to give us therefore 190. Therefore, the cost of this item sold on the fourth day is therefore equal to $190. That's the result. The first in, first out. This sale made on the fourth day, we pick the item first from first day. Then, if not enough, go to the second day. If not enough, go to the third day. Is that clear? That's the use of the first in, first out method. Aisha, it's clear?
Yeah.
Okay, great. Now there's a question I want to ask you guys. Okay, let's go back to our questions, our notes. There's a question there which I want you to do. Let me see how far. It should be a very easy one for sure. Okay, so do this in the next 2 minutes. Come up with an answer. The same process. Okay, and there's no trick here. The same process.